100 Baggers, Part 2. This audio recording is dedicated to making the coach read more. For all the detailed financial analysis in this case study, the essence of the deal is right here in this table. And the table depicts ROE, net income divided by shareholder equity, from 2002 to 2006. You see a rapid increase in sales, rising profits, and a rising ROE. We'll get to ROE in Chapter 6. If there is a detectable formula for 100 baggerdom, this is it. You could have bought shares in 2004, well along in the story, and still made 100 times your money. You didn't have to do all the deep financial work on display here. In fact, it probably would have helped if you didn't, because a lot of smart financial people said it wouldn't work. But more on that in a bit. It is easy to see the business quality when studying the above table, Yoda writes. So why didn't everyone get rich? Very few people followed the story early on. And then the table below has number of analysts of conference calls, probably a very key indicator for investing. From quarter 2 of 03 to quarter 2 of 04, it went from 1 to 8. And a little more detail on the table at the top of page 52. Operating income went up exponentially from 5,293 in units of millions, I believe, to 158,579 in 2006. Net income also ballooned exponentially. Earnings per share did the same. Long-term debt decreased massively at 10x to the downside. Shareholder equity also went up 10x to the upside. ROE ballooned massively from 10.68% in 2002 to 43.52% in 2006. And even if you knew the story, you had to hold on, even if you looked silly, and even if sophisticated people told you it wouldn't work. The Value Investors Club is a widely followed stock research platform full of sophisticated people. And in 2005, an author using a pen name posted Hanson's as a short, that is, betting against it. This poster had won the Vic competition 3 times, which Yoda believes must be one of the best records ever. So, he was not some unknown in damning Hanson's. The write-up was well received by the distinguished group of investors, Yoda writes. One even chimed in, "No strategic player is going to buy this company. It is clearly overvalued, marginal player and a fad business that has very average brand with no distribution edge." The author wrote this up at a split adjusted price of $6.31. Not only did Hanson never trade as low as $6.31 again, but inside of 12 months, the stock was $26. The company changed its name to Monster Beverage, its now signature product, in 2012. Looking at historical results, it's interesting to note that Monster never really got expensive, despite its reputation as a high flyer. Its price-to-earnings ratio was never out of line with its growth rate. And another table here, this book loves tables. From 2005 to 2014, the price-to-earnings ratio increased from 28x to 39x. Percent EPS growth was 218%, and then it fluctuated. It was actually down in 2008, and we all know why that was. And then 2014, it was 42%. So some fluctuation there. Monster shows us the power of high sales growth and building a brand, and the potent mix of high sales growth and rising profit margins and rising return on equity. It also shows you how independent-minded you had to be. There was no shortage of smart people telling you why Monster wouldn't work. But it did work, and in spectacular fashion. Next case study, Amazon. Next up is a name that will not need much of an introduction. The online retailing giant was a 100 bagger more than twice over, and I believe now, because this book is it's several years old, so Amazon is more than just that. Thomson Clark, one of the analysts I mentioned earlier, prepared the case study on Amazon, and what he found will surprise you. He's cracked the code of what makes Amazon great. Amazon was one you could have bought right out of the gate. Shares started trading in May of 1997. After adjusting for stock splits, your effective purchase price was $1.50. Before the century was done, you had your 100 bagger. Thompson writes, shares hit a high of 221 in April of 1999. Your gains were a cool 14,633%, a 146 bagger, which would have had you partying like it's 1999. But that return was so fleeting, it doesn't count for purposes of our study, which uses year-end data. Amazon wouldn't see a price that high for more than a decade. Amazon was, as you might imagine, not spared by the dot-com bust, Thompson points out. Shares fell back to earth, touching single digits by the middle of 2001. Looked at through the lens of our study, Amazon took about 13 years to turn into a 100 bagger. And by May of 2015, you were sitting on gains of 28,300%, or a 283 bagger. So in the years after that, obviously it went way higher. We'll have to add in how much of an actual bagger it is. So how does Amazon do it? Let's start with Jeff Bezos, because this is a case where you had one of the great owner-operators at the helm. Bezos is currently 51 years old at the time of this book and owns 18% of the company, of which he is both CEO and chairman of the board. There are no signs he's leaving either, Thompson writes. In a 2014 Business Insider interview, Bezos, perhaps channeling Mr. Buffett, said, "I still run into work." He loves what he does. He started the company when he was 30. He used to work at D.E. Shaw, an investment management company. Importantly, he's not a programmer like Bill Gates. As Thompson says, he's a Wall Street guy in a lot of ways. At heart, he understands two things, Thompson writes. He understands the value of a business and is the sum of its future free cash flows discounted back to the present. And he understands capital allocation and the importance of return on invested capital. The latter, as we've seen, and we'll see more of later, is critical to 100 baggerdom. Thompson marshals some good evidence on Bezos' thinking, highlighting the key phrases. From Bezos' 1999 shareholder letter, each of the previous goals I've outlined contribute to our long-standing objective of building the best, most profitable, highest return on capital, long-term franchise. From Bezos' first shareholder letter in 1997, market leadership can translate directly to higher revenue, higher profitability, greater capital velocity, and correspondingly stronger returns on invested capital. Our decisions have consistently reflected this focus. He has a relentless focus on the long term. Every year, Thompson adds, he includes his 1997 shareholder letter at the end of the current year letter. The point he's trying to emphasize, it's all about the long term. So we all know Amazon came to dominate online retailing. The question is, could you have come up with a sound argument to buy Amazon based on fundamentals before it became a 100 bagger? Thompson argues for an emphatic yes, and I agree with his reasoning. Before I get to that, I want to start with a big picture observation. Thompson shared a chart that I found truly remarkable and thought about for several minutes as the implications rushed through my head. See the chart below, which reveals the growth of e-commerce as a percentage of overall US retail sales. And since, of course, we can see the chart right in front of us, just kidding, only I can, I'm going to describe it to you. It's e-commerce as a percent of total retail sales in the US from 1998 to 2014. There was 300 billion plus of spending. From 1998 to 2014, this percentage went from just over 0% to almost 10% as a percent of total retail sales, which makes sense. That's the era we were in. It almost seems obvious now, but it was so hard to imagine back in 1998 or 2002 that internet sales would someday make up more than sub 2% of retail sales. Seeing this makes me wonder where my head was. I never owned Amazon, despite being a heavy user of its services. And what's incredible about it is that even today, only 9% of all US retail sales happen over the internet. Amazon started when this was almost nothing. Even now, it is a stretch to think internet sales could make up 35% of all retail sales, or even half. Maybe this 100 bagger has a long way to go. And keep in mind, this book is a bit outdated. Amazon obviously had a long way that it went from there. But to get back to Thompson's analysis, first, there's an important myth to dispel about Amazon, Thompson writes. The consensus opinion is pretty clear. Amazon does not make money. Is that true? Absolutely not. Remember Bezos' first shareholder letter in 1997. He emphasized return on invested capital and investing for the future. One way Amazon does this is by spending a lot on research and development, which is a form of investment. I went through Amazon's historical results, Thompson wrote, which, by the way, are fantastic. Sales have grown at a compounded annual rate of over 40% since the year 1997. So here again, we see those important ingredients: growth, growth, and more growth. Looking at Amazon's reported operating income, it doesn't look profitable, Thompson continues. On 88 billion in 2014 sales, Amazon earned a measly 178 million in operating income. That's a razor-thin 0.2% operating margin. Adding back R&D, however, paints a completely different picture. In 2014, Amazon spent 9.2 billion on R&D. Adding that back to operating income, Amazon generated adjusted operating income of 9.4 billion in 2014. So that's an operating margin of 10.6%. Very impressive, and what's even more impressive is how consistent this trend is. Thompson created the table on the next page. Adding back R&D may sound crazy, but the point is to think of R&D as an investment in this case. There is a long history of debate in accounting circles about how to treat R&D. Should it be expensed against sales, or should it be capitalized on the balance sheet like property and depreciated or amortized over time in bits? The tables here I'm going to describe briefly. From 1996 to 2002, sales growth percentage. It's got dollars and percentage, so 1575 all the way to 3,933, percentage 838% in 97, 26% in 2002, operating income, R&D. It's got all the percentages here. It's very impressive. And then sales growth, it's actually got it put the whole chart from 96 to 2014 on the page. So it's got, and it's phenomenal. So we started at 1575 in 96. We were at 88,968 in 2014 in terms of sales revenue. It's phenomenal the way it grew. My higher level point is simply that Amazon could have been profitable if it wanted to, Thompson writes. If it wanted to show earnings, it could have. It didn't. The layman who might be interested in buying Amazon stock would certainly be turned off by its lack of ever being profitable. Well, if you back out R&D, effectively backing out CapEx, you see how profitable it really has been. He recognizes to do this properly, you'd want to amortize those R&D costs over some time period, the same way a firm would amortize costs spent on equipment. There is some component of R&D that is essential to keep Amazon going, but there is also a growth component that helps generate future sales. What's the mix between growth and maintenance R&D? Thompson asks. No idea, but it's an important question and worth discussing. For purposes of this exercise, let's look at R&D as an investment Amazon makes to grow its business. Since 2003, as Thompson notes, operating margin excluding R&D has been almost exactly 10%. Now, could a savvy fundamental investor ever have made the case for Amazon? Thompson asked. Sure. Let's go back to early 2003. Share price $21.94. Don't we miss those days? Wish we bought then. Enterprise value equals 8.3 billion. 2002 sales of 3.9 billion. 2002 earnings before interest and taxes ex R&D 279 million. 2002 adjusted operating margin equals 7%. EV divided by EBIT is 33, an extremely steep multiple. And if everyone's staying awake with me, at this point, though, Thompson adds, a tiny fraction of the United States was online, and an ever tinier fraction of retail sales was made online. In other words, this runaway was massive. See the chart on page 55, which we referenced already. Let's say your projected sales growth of 30% per year. Your 2005 sales target would be 7.6 billion. Put a 10% margin on that, consistent with the trend of EBIT x R&D, you'd be buying Amazon right at 10 times 2005 operating income x R&D. That's a very conservative multiple. I pause here to note this wouldn't have been easy, but it would have been possible to think about. Along with your earnings growth, share price had grown as well. Your $21.94 investment had risen to $43.92 by February of 2006. That's a double in 3 years for a compounded annual growth rate, also known as CAGR, of 26%. And over the same period, you would have crushed the S&P 500, which had risen half that at just 50%, or 14.3% per year. By 2006, you were along for the long ride. Hanging on to shares up until May of 2015 would have netted you a 15-bagger or a compounded 26% annualized return. That's annualized, and once again, very impressive. So it would not have been easy to net a 100-bagger on Amazon. You would have to have had a strong conviction early that is an idea, it would work. And you would have had to sit through a soul-crushing decline where it lost more than 80% of its value, which, knowing the psychology of investing, and I probably would have done this too, most of us would have sold before then or taken our losses at that point. But you also would have had many chances to buy it at those low prices, such that while you might not have netted a 100 bagger, you could easily have been up 50-fold. And Amazon is not done, and they're still not done, actually. You have to have trusted Bezos, and you have to have been clued into his thinking. If he wanted to, Bezos could cut R&D expenses and Amazon would gush cash. Instead, he invests the money and creates new growth. So it's like they don't pay a dividend, but they're allocating what would be a dividend for you. Kind of a novel idea to a lot of us dividend investors. Thompson sums it up this way: if you trust in Bezos, you're okay with the company having razor-thin operating margins. In 2014, operating margins were 0.2%. Adding back R&D, however, gets you an adjusted operating margin of 10%. I showed in the table above how remarkably consistent this trend is. Making a fundamental case for Amazon and getting a 100 bagger would be very hard to do. Your best bet was to buy at the IPO and bet purely on growing retail sales. The chart on internet sales and trust in Bezos would be the keys to your thesis. I make the fundamental case that in February of 2003, you could have bought Amazon based on trailing numbers and conservative assumptions. That would have brought your gains to 15x or 26% compounded in 2014. Thompson goes further and thinks that Amazon may be a buy even today. I actually think so too. And this is probably 7 years or 8 years after the book was written. And it still could be a buy. I'll share his analysis in the nearby table. Based on today's price, his analysis gets you to a 127% return or a CAGR of 31% over the next 3 years. The biggest point to convey, Thompson wraps up, is that a return on capital is extremely important. If a company can continue to reinvest at high rates of return, the stock and earnings compound, getting you that parabolic effect. It's a point we will return to again and again. Another chart here depicts what they were just talking about with the CAGR. This is actually the 2017 valuation, 31% CAGR, 127% upside based on running their own analysis here. And you all will like this one. The projected price in 2025 that the book has is $427 a share, and an enterprise value of 196,807, and that's in units of millions, I want to say. And we'll do a video one day on statement analysis and valuation. At this point, I have a few more case studies to share with fewer financial details, but that nonetheless serve to illustrate the essential characteristic of 100 baggers. You need to have a long runway to grow. Alejandro, one of the analysts I mentioned earlier, prepared the following case studies. Electronic Arts. An American entrepreneur named Trip Hawkins started Electronic Arts after leaving his post as a director of strategy and marketing at Apple in 1982. Based in Redwood City, California, the company develops and publishes video games. EA became a 100 bagger in just 14 years. It hit the mark in 2004 and kept going. Here, Alejandro did the research on EA. The video game industry is still relatively young, 40 years or so, and remains incredibly competitive. Founding members of this multi-billion-dollar industry have faltered and been overtaken by new players. He points out that the founding titans such as Atari and Sega no longer dominate as they once did. Even Nintendo has lost some of its competitive edge to newer players. Sony, PlayStation, and Microsoft Xbox have become the dominant players for the console market, Alejandro writes. But they face increasing competition from game developers who skip the console route. The latter instead go directly to consumers via the internet or through apps. Therefore, it's extremely interesting to dissect Electronic Arts, an American video game developer, and its path to 100 bagger status. Its success provides insights into how to succeed when faced with the uncertainty of both technology and fickle human tastes. It seemed to do this by creating hit after hit and by securing key licenses to valuable franchises, thereby keeping competitors out. First, you can see the unpredictable nature of the business in its erratic profitability. Profit margins and return on assets jumped around quite a bit from year to year, following game hits and misses and new or update releases. EA's wild profit ride, this chart depicts from 1990 to 2006, and it was definitely up and down, very choppy. One year, 1994, it was up 156%. Most other years, it was either in slightly double or single digits. Unlike many of today's tech companies, EA focused on its bottom line. One of the early examples of EA's ability to protect margins was to avoid existing distribution partners. Instead, they opted to deal directly with retailers, which gave them better margins. EA experimented with different forms of packaging. For example, EA used album style packaging for games in the early 1980s, such as Mule and Pinball Construction Set. This type of packaging was pioneered by EA because the record album style could save costs, as Alejandro points out. EA also focused on making games for all consoles, so it skipped out on the costly and competitive console hardware segment. EA's executives still credit this strategy as a foundation of their business success today. Whatever you choose to emphasize, EA pushed the right buttons. In 1990, sales were just 96 million. By 2004, sales were 3.1 billion. That's a 32-fold increase. The multiple the market put on those sales also exploded from 2.7 in 1990 to 13 by 2004. Earnings also popped. Earnings totaled 8 million in 1990. By 2004, they were 586 million. That's a 73-fold increase. And the price to earnings ratio went from about 12 to 32. For those kinds of numbers, EA needed more than smart packaging and games for all consoles. It needed to create games people wanted. EA's founders chose this name, so the story goes, because they wanted to promote their games as a kind of art. Art in an almost Hollywood type sense, as some believe the name was actually inspired by the legendary United Artists Studio. EA treated its game developers like rock stars. EA gave its developers personal credit for the creation of a game. This was allegedly done through not just financial incentives, but also PR type activities that celebrated them along with their work. He continues, the album covers for the games in the 1980s also reinforced the idea that these gamers, or these games and their creators, were something more than geeks who had the capacity to make playful images on a screen. All of this focus on quality led to some very successful games. This is especially true in sports, where EA's franchise is basically unrivaled. I grew up in the 1980s, and I can still recall their tagline, EA Sports. If it's in the game, it's in the game. And how we spent hours playing Madden football in college, and I can actually relate to that myself. Spent a lot of time playing that game, got really good at it. That part's not in the book, by the way. The realism of their games has basically outflanked most other sports games out there. This has in turn led them to have exclusive rights to the development of games for several professional leagues, along with that of their players. Madden NFL, NBA Live, FIFA, NHL, and PGA Tour Series have all been produced under the EA Sports label since the late 1980s and early 90s. FIFA, its most successful sports franchise, broke its 100 million unit sale in 2010. EA had other franchises too that were hit franchises like SimCity, Battlefield, and the Need for Speed series. And I remember some of those myself. To have so many hit franchises under one roof is exactly why this company has consistently grown since its inception. EA is intriguing on many levels. It was in what seems a fickle industry, but managed to create a culture that produced winning games. And you see here what you'll see with nearly all of the 100 baggers, explosive growth in sales. Added to this, EA had healthy, if erratic, earnings and profit margins. This is one where you had to believe the story and think big, which is also required for 100 baggerdom. And as a side note, once Disney bought Star Wars, I believe EA actually started producing the Lucasfilm games, if I'm not mistaken. Next case study, Comcast. Ralph Roberts transformed what was a tiny Mississippi cable company into the industry giant we know today as Comcast. The roots of the story go back to the 1960s. According to the Wall Street Journal obituary of Roberts, who died in June of 2015, cable television in those days was still a tiny business of community antennas and strung up wires. Mr. Roberts got wind of it through a chance meeting with a cable system owner who was looking to get a struggling Southern cable distributor off his hands. Smelling opportunity, Mr. Roberts made his first acquisition in 1963, a Tupelo, Mississippi cable operator transmitting signals for 1,200 local residents. The shares listed on the NASDAQ in 1972 and are up more than 100,000% since. This is one rare case where we have a great founder operator and Ralph Roberts. And then we have a second capable operator and his fourth son, Brian Robert, who became president in 1990 and CEO in 2002. For purposes of our study, we began the clock with the lows in 1981. From that point, it took almost 18 years to get to 100x. Comcast is an interesting case study because, as with Amazon, you did not see steady earnings growth. In fact, Comcast often reported losses as it spent heavily on building its cable systems. You had to see beyond reported figures to understand the value of its subscriber network. Sticky customers who pay every month, year after year, formed the backbone of any Comcast investment thesis. While you did see, or while you did not see earnings, what you did see was sales growth and growth in subscribers. In the 1980s and 1990s, Comcast went through substantial growth because of various acquisitions. For example, the purchase of a 26% stake of Group W Cable in 1986 doubled Comcast's number of subscribers to 1 million. While their acquisition of MacLean Hunter's American division in 1984 allowed Comcast to reach a total of 3.5 million subscribers and made Comcast the third largest operator in the United States. It would keep going. In 1995, Comcast acquired EW Scripps Company for $1.575 billion. The latter was a company with cable subscribers, and this pushed Comcast's total number of subscribers to 4.3 million. Comcast also began to diversify its portfolio of businesses. It acquired a majority stake in QVC, a home shopping television network, for $2.1 billion in 1995. Comcast would also become a player in the mobile and internet industries, first with their purchase of American Cellular Network Corporation, a regional mobile service, for $230 million in 1988. The second took place in 1996 with their launch of the Home Network, which offered internet services. These efforts earned Comcast a $1 billion investment from Microsoft in 1997. Comcast's integrated approach to cable distribution, programming, and telecommunications complements that vision of linking PCs and TVs. Today's announcement will enhance the integration of broadband pipes and content to expand the services offered to consumers, said Microsoft founder Bill Gates in a press release then. The acquisitions continued. Two big ones were the 2001 acquisition of AT&T's cable system, and in 2011, the acquisition of NBC Universal. Comcast network also became an important highway for the internet, and that propelled growth even further. You can see how Comcast sales really began to build as we got into the late 1990s and early 2000s. And the sales chart depicted here, from 1981 to 2001, we see an increase in millions of dollars from, well, the number in the chart, it's close to zero, but it's between 0 and 2,000 in terms of millions, but it got all the way up to 10,000 million. What's most interesting is this was still early in the story. Comcast would eventually grow sales more than 6 times from 2001 as it continued to expand and acquire companies. Big acquisitions during this time include AT&T Broadband, Adelphia, 50/50 with Time Warner Cable, and a 51% stake of NBC Universal. An investor would have had to sit through a nasty fall as the 2000 stock market bubble burst. Comcast shares would give up about half their value from the peak to the trough in 2002. But then it was off to the races once again. An investor who held on through 2014 would have had a 188 bagger. This is a short case study, but it serves to highlight again the power of sales growth and the ability to see something beyond the reported earnings. Netting a 100 bagger takes vision and tenacity and often a conviction in an idea that may not yet be obvious in the financials. Next case study is Pepsi. Pepsi is perhaps more typical of a 100 bagger than you may uncover. It's a simple business with good margins that just grew and grew into big markets. Pepsi is another case of a stock making the 100 bagger list in both Phelps' study and my own. In Phelps' book, the story began with Loft Inc., which absorbed PepsiCo and rebranded itself as such in 1941. There's a lot of interesting backstory here that would take us too far afield. But here's a bit of interesting trivia. Pepsi filed for bankruptcy twice, in 1923, 100 years ago, and again in 1931. According to Phelps, if you had bought the stock in 1938, your cost basis would have been 75 cents per share. That steak was worth $427 in 1971, which was a 569 bagger over 33 years. Phenomenal. In our study, the story picks up in 1962. It took the New York-based soft drinks and snacks giant 28.5 years to hit 100-bagger status from 1962. In fact, from 1962 to the late 1980s, the stock showed no signs of being a 100-bagger in the making. But then it kicked off a huge international expansion. By 1985, Pepsi had a presence in close to 150 countries. These include China, which opened its doors to them the same year, as well as the Soviet Union a decade earlier. These two nascent markets that would make PepsiCo a lot of money over the next couple of decades. Along the way, the company continued to introduce new products and expand its snack business. In 1982, Pepsi developed their Slice brand, which made sodas with a small amount of fruit juice. This created a new market and thereby increasing its market share of the drinks industry. In 1986, it got into fast food, picking up KFC and Taco Bell. In 1989, PepsiCo acquired Britain-based Walker's Crisp and Smith Crisps, leading snack food companies in the UK. This list of international hits kept coming. In 1990, PepsiCo signed its largest commercial trade agreement in history with the Soviet Union. The same year, PepsiCo gained a controlling interest in Gamesa, the largest cookie company in Mexico. In 1994, PepsiCo also expanded into Vietnam. This made it the first major soft drink maker to begin production and distribution within that country. It also formed a partnership with Starbucks to offer ready-made coffee drinks in the United States. In 1998, Pepsi entered into a joint agreement with Empresas Polar S.A. of Venezuela and became the biggest snack chip dealer in Latin America. This deal was part of the 1995 plan to introduce its Lay products to an additional 20 markets around the world. The list of acquisitions of new properties continued too. Aquafina in 1997 and Tropicana in 1998. Also, as a side note, if you all see those Simply products, that's a Pepsi product as well. Financially, I'm drawn to two facts. The first is Pepsi's consistently high gross profit margins of 57% or better. As we'll see later in Chapter 12, this is a clue to the competitive position of Pepsi. And second, the sales and profit growth was remarkable over time, as we've come to expect. Sales in 1962 were just 192 million. By 2014, they were over 64 billion. And this doesn't include the eventual spin-out of Yum Brands. Likewise, net profits went from 15 million to over 6 billion. Over the period covered by the study, PepsiCo returned more than 1,000-fold. Next case study is Gillette. Gillette took nearly 32 years to become a 100-bagger. You know the company as the maker of razor blades. Gillette, which has been owned by Procter & Gamble for the past 10 years, has been estimated to possess as much as 70% of the razor blade market. Founded in 1901, the firm had a lot of success early. As an interesting side point, Phelps included Gillette in his book. The stock was a 100-bagger from 1943 to 1971. The cost in 1943 was just $4.75, and that would have grown to $364 per share by 1971. Fortune's July 1962 issue named it the third most profitable company in America. Which reminds me, I need to shave. In my research of 100 baggers, I have seen that a constant desire to grow a business is a key characteristic. He found this trait throughout Gillette's history. It was always expanding into new markets and creating new products. Alejandro found Gillette's use of technology was important. One of the ways that they were able to do this so effectively was through their wise use of technology for the development and marketing of products. Throughout its history, Gillette executives showed an understanding of technology that gave them an edge over their competitors. As Darwin said, "It is not the strongest or the most intelligent who will survive, but those who can best manage change." That could be the quote of the day. For example, Gillette was an early adopter in the use of television advertising. In 1944, when television was largely ignored by brands, Gillette executives took a gamble on it. And this greatly enhanced the visibility of Gillette's brand. Gillette didn't just spend money on advertising either, but tracked sales using data. Ultimately, Gillette found it helped boost sales in those early years. Another technology play that benefited Gillette was their decision to continuously work on improvements for their blades. They even did this when there's no sign of a competitor with a product that could take away a portion of their market. This was partly because they found loyal customers who would pay more for a blade that was slightly better than the one they currently used. Alejandro cites a line from Peter K. Hoffman, president of Gillette's grooming division, in 2001. History has shown there is a portion of the market that is anxious for our next innovation. This was something Gillette figured out early. The focus on research and development also proved a tough moat for competitors to cross. Even when it wasn't first to the market, Gillette could use its own patent portfolio to cut out competitors' blades. For example, in 1962, Tiny Wilkinson Sword Ltd. Of London introduced a set of coated stainless steel blades with a lot of success. Users claimed that they could get at least a dozen smooth shaves from the product, while they got only 3 or 4 from Gillette's carbon steel blades. Wilkinson's blade could have seriously impacted Gillette's dominant position. However, Gillette researchers had actually patented the stainless steel coating process before Wilkinson could obtain a patent. So Gillette received a royalty for each stainless blade sold by Wilkinson. This crippled Wilkinson. A year after the Wilkinson shock, Gillette introduced its own stainless steel blade in 1963. They priced it below Wilkinson and their American competitors. By doing this, they would again essentially dominate the market and would launch yet another set of slightly improved blades a couple of years later. Gillette was and is a great business, and yet, looking at the first couple of decades of Gillette as a public company, you'd be hard pressed to find signs that it would one day be a 100 bagger. In fact, for the first 20 years, the stock didn't advance all that much. It went up about 40%, and that's it. If you took all your dividends and reinvested them, you'd have had about $340 for every $100 you invested. That's much better, but not so hot for 2 decades. That's about 6.5% annualized, which is slow. Recall that even at a 10% annual return, you'd need 48 years to turn a 100 bagger. Gillette's pace was only 2/3 of that. This is despite its consistent net income growth during this period, Alejandro points out. The latter grew 3.5-fold. Part of the reason is valuation. Gillette did not get the benefits of the twin engines. Earnings grew, but the multiple on those earnings actually contracted. In 1962, it traded for around 20 times earnings, but 2 decades later, the market had the stock trading for just 10 times earnings. But part of it was also Gillette's falling profit margins and falling return on assets. And the table depicted on page 70, from 1962 to 1983, we have all the profit margins and ROAs, and there's no discernible trend. It does look like it fell, but it's not really that steep. In other words, it took more and more sales and more assets to generate a given dollar of profits. Its return on equity, another important measure, which we'll look at in Chapter 6, also fell. It earned 31% on every dollar invested in 1962, but by 1982, it earned 18%. Despite its many advantages, Gillette's business was clearly not as good as it was in 1962. There were several reasons for this. Gillette had to, at times, lower the prices of their products in order to compete, just as they did with the Wilkinson stainless steel blade. Also, R&D costs, coupled with the expenses of Gillette's continuous product launches, both domestically and worldwide, required a substantial amount of capital. It was only when Gillette reversed these trends that its real march to 100 baggerdom began in earnest. The valuation bottomed out too. By the time it became a 100 bagger from 1964 to the middle of 1995, the stock's price to earnings ratio was a rich 28. Sales and earnings also grew more rapidly. Sales grew nearly 11% annually from 1982 over the next 15 years. Earnings grew even faster at nearly a 15% clip over the same period. And no doubt, a healthier economic environment contributed to the better performance in the 1980s and 1990s versus the 1970s. Even so, such things are not predictable, and this is why I and Phelps and others recommended you don't bother to try to be an economic forecaster. I'll have more to say about this in later chapters. The Gillette case study reinforces several things we've learned so far. The importance of growth, for one thing. In this, Gillette was arguably easier to see than Amazon or Comcast. It kept up profit margins and enjoyed lush returns on both equity and assets. The Gillette case study also shows how valuation makes a big difference over time as the stock moves from a lower multiple of earnings to a higher one. Having said that, you ought to prefer to pay a healthy price for a fast growing, high return business such as Monster than a cheap price for a mediocre business. A little math shows why. Peter Lynch ran through an example in his book One Up on Wall Street. All else being equal, a 20% growth selling at 20 times earnings, a PE of 20, is a much better buy than a 10% grower selling at 10 times earnings, a PE of 10. This may sound like an esoteric point, but it's important to understand what happens to the earnings of the faster growers that propel the stock price. Here's the math. And this is a chart again, base year from year 1, 2, 3, 4, 5, 7. They skip years 8 and 9. Company A with 20% earnings growth rate compared to Company B at a 10% earnings growth rate, it makes a big difference. This is basically the compounding effect. So it's $1 in the base year, it's $6.19 in year 10. With 10% earnings growth rate, it's $1 in base year and $2.59 in year 10. I'll have to re-examine this later and do my own math on it. You can see what a radically different place you'd end up at with the fast grower after 5, 7, and 10 years. If both stocks retain their PE, Company A will end up at 123.80 and will hand you a 5-bagger. Company B will sell for 25.90 and give you a double. Even if the 20 PE stock fell to 10 PE, you'd wind up with a lot more money still, a triple. As Phelps reminds us, good stocks are seldom without friends. Hence, they are rarely cheap in the usual sense. Don't let a seemingly high initial multiple scare you away from a great stock. And to summarize, there is no end to this kind of analysis. We could create a case study for each of the 365 100 baggers. That would make for some tough reading. Good thing we're doing audiobooks, huh? So I won't spend too much time on case studies, even though we just spent 42 minutes on them. We've done enough with a range of 100 baggers, and we have a basic template emerging, which I'll return to at the end of the book. Again, I'd like to emphasize that I don't take the statistical approach very seriously here. I am tempted to give more numbers on what a typical 100 bagger looked like, but that would be like giving you the average price of real estate in Columbus, Ohio. The latter doesn't tell you much because there is residential property, commercial property, industrial property, and so forth. The population is too diverse. The number doesn't mean anything. It's the same with 100 baggers. For the next few chapters, though, I'd like to explore further the qualities you'll want to look for in these big winners. And with that, the next chapter will be the key to 100 baggers. We're going to have to save that for the next live stream. This is the first ever reading I've done on Thanksgiving Day. I did it for all of you all. Been talking about doing it for a while. And there may be 5 parts unless I make parts 3 and 4 bigger. So thank you all for listening to this live stream again. Again, this live stream is dedicated to getting the coach to read. And I like this because I can record audio and it gets me to read. So thank you all. Like, comment, and subscribe. And thank you all again. Have a great Thanksgiving Day.